Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for November 16th of 2025. So I want to get started this week on some valuation topics here, talking about global markets and then kind of focusing a little bit on the U.S. market and then digging into kind of the market dynamics and where we sit right now and then transitioning over into some economic data that I think is pretty important to talk about right now. So let's start with this chart. So this represents a lot of markets around the globe. You can see the U.S. market here on the far left. And this is basically a rank sort of all of the current valuations that we see across the globe. And what's really interesting here, in the way that you read this, you've got the interquartile range. So this is basically, the 25th percentile to the 75th percentile. So this is basically where you'd expect most of your occurrences to fall. And then these squares are your median. And these diamonds represent the current valuation. Now, these are price to earnings ratios across the world. And you can see the U.S. price to earnings ratio is on a forward basis is almost 23 times. And you can see that's well above the median, well above the tight range, even well above the 90th percentile. Basically, you've got anything out of this band here represents something that's in kind of, I'll call it nosebleed territory, in the sense that it's just not a common occurrence. And what's really interesting here is even if you back out technology, which again we're going to talk about a little bit later, the S&P is not your father's S&P index anymore. We're also going to talk about the world index, the all country world index rather, about 19 times. And you can see that these valuations get less onerous as you get into some of these markets like EM, Europe, Asia Pacific, ex-Japan, China, which honestly shouldn't be emerging markets anymore. But you have lower overall multiples, but they're still well above their median range. And so we have a market that is really replete with liquidity. And you can see all these markets are trading above their historical averages, but the U.S. clearly is an outlier here at almost 23 times. So we look specifically at the S&P 500, kind of a similar chart here. This would be essentially the this little box here, and in this case it would be for information technology, represents the 25th to 75th percentile range for the number of observations that you would expect to see a forward price to earnings ratio. Of course, we just got through talking that technology multiples are very high. They sit at the top of their range. And oddly enough, for consumer discretionary, they're in the same boat, which is very, very interesting. You go over here to consumer staples, you've got aggregate multiples that are not nearly as high. You can see, it represents 20 times. You can see 30 times, which is where technology and some of the consumer discretionary names are, which is extraordinarily high. And the average, as you might glean from this chart, is somewhere around 16 and a half times. And you can see the only one that's trading, oddly enough, below its median historical price to earnings ratio is energy right now. And you've got everything that's trading above its median. Some are trading a little bit tighter within kind of a normalized range, maybe trading at the upper end of that. But clearly, information technology is driving the boat for the S&P 500 right now, and the index will go as technology goes. Got some slides here, research from Goldman Sachs. A little bit of data. We'll focus on the left side first. So basically, this is looking at global equities. So not the U.S., but this is global equities. And they expect that global equities will deliver a total return over the next 10 years of about 7.7%. You can see this bell curve right here. So, they're looking at various long-term projections. And long-term, they're looking at about 9.3%. This is their 10-year forecast of 7.7, obviously below the long-term. Over the last decade, global stocks have returned about 12%, and since the global financial crisis have returned about 7%. So certainly not as good as the last decade is in the cards from the work that Goldman's done, and maybe a little bit below a long-term average here, but still a respectable number. As you see in the bell curve here, that it falls just slightly below the midline. Now, if you transition over to the right-hand side, again, really same data. You've got the rolling 10-year return, and it's just kind of depicted a little bit differently. Here's your median following the global financial crisis in this gray line. And then here's the median since 1985. So we transition over to the S&P 500. Goldman is now looking for a 10-year return of 6.5%. So that's, as we saw a couple slides ago, that's below the estimate for the global markets. And and as we saw also that or we will see, the global markets are expected to perform better than the U.S. By and large over the next 10 years. So base case here is 6.5%. Really, their upper boundary of their expectation range is about 10%. The downside is around 3%. And obviously, that's below the past decade of around 15%. So here we have the chart that I was alluding to in that last one, where these other markets are expected to generate better performance, better returns over the next 10 years in the United States. You've got emerging markets here expected to produce about an 11% return. Asia Pacific ex Japan about 10.3%, and then Japan 8%, a little bit above that, and then Europe around 7%, and then U.S. around 6.5%. And you can see the derivation of this, that the earnings are going to play a part in all of these earnings growth and total return numbers over the next decade. Here we have something I thought is very interesting, something you wouldn't have predicted, and you'll hear me say that a couple times in the chart pack, that we have a lot of different global markets that are exhibiting earnings results that are trending much higher than their historical average. And the way that we kind of look at this chart is that you've got essentially the proportion of companies that are beating on earnings. Now, historically in the United States, that number is around 74%. 74% of companies during an earnings season will typically beat their estimates. Well, lately that's looking more like 82%, which is unusual, and it certainly was not expected. If you were thinking about all this about 6 months ago. Here we have some of the other areas. Japan. Here's the overall global. Again, same deal. You've got an average beat rate of around, call it 60%, and you're trending at 64%. Europe, emerging markets, and then even emerging markets ex-China. You've got earnings results that are coming in, for all intents and purposes, much better than expected. Well, continuing this theme on the fundamental performance of stocks, we have here the S&P 500 return, and what is the derivation of that return? And again, from the department of I wouldn't have expected this is two things here. One, I knew we were going to get earnings growth, but obviously very few people predicted that we're going to have 10% earnings growth to help drive a 15% return. And very few people honestly would have thought that you'd have multiple growth. And that means like earnings, price to earnings multiples that are expanding. But there's a lot of liquidity sloshing around. And obviously, as we've just seen in the last few slides, that's not just the U.S. market that's benefiting from that liquidity. It's all of the global markets, even though the U.S. markets have a much higher multiple or are much, much more expensive than the rest of the global markets. But again, you've got earnings that are driving this. Within earnings, you've got margin expansion, another thing that we just would not have thought that we were going to see a lot of 6 to 9 months ago, and then this multiple expansion that I just mentioned. So when you think about all of those fundamental factors and what it does to an equity market, obviously it gives it energy, it gives it fuel to continue to drive, and we're in a kind of an unusual spot now. So this is the a chart depicting the number of consecutive trading days where the S&P 500 index has been above its 50-day or short-term moving average. And you can see that we're not quite 150 yet. But in a time series that goes back to 1970, the last time we saw this type of trend, it was 2007. And we all know what happened the following year. We had the global financial crisis. So I don't want to get people scared. It's just that we've got a volatility chart to show you. Volatility has picked up a little bit, but it's not out of line. Obviously, you've got times where volatility spikes. And you can see here very notably, basically when you get to, points like the tech bubble bursting and whatnot, you have these episodes. But again, you've got to go back quite a while to see a market that's trended kind of robotically upwards like it has recently. Yeah, we'll visit a little bit about market concentration, which I think is certainly creating some risk on the margin for the equity markets. And so this is a chart showing the differential between the market cap of the largest stock in the index versus the 75th percentile stock, and that is really just kind of a proxy for an above average size company within the S&P 500. And this data series is very telling because it goes back all the way to 1925. And you can see, the various points in time that might, have some coincidence to you, where this concentration was really high, and this value was really, really high, and it is extraordinarily high right now. And then we have a chart coming up next, which breaks this out specifically, but the weight of the top 10 stocks in the S&P 500 is above 40%, and that's pretty telling. Again, you go back to 2020 when we had this case. Well, that was we had a little issue called the pandemic. 2000 tech bubble. 2009, it was in the aftermath of the global financial crisis. You had the oil embargo, 1973, and you've got these episodes going back in time that, again, just make you want to be eyes wide open to the current environment. And as promised, here's that chart of the top 10 company weights. This is a kind of a cleaner chart of what that looks like. And again, going back to 1960, you can see that there was quite a bit of concentration. Again, the index looked a lot different back then, had a lot more of an industrial focus and consumer staple focus. Much more technology driven now, and you can see here just the dramatic rise in that concentration, over a relatively short period of time. A couple other things to mention here, the dynamics kind of in the markets that are partially driven by the technologies sector here. You see small cap versus large cap. Small caps are definitely underperforming. This goes back to August, so not a long time series. We were making up some difference or some deficits here, I guess, with regard to small caps performing a little bit better relative to large caps, and that has certainly gone the other way now. And so we're now testing those multi-month troughs at the current time. So in addition to basically large caps outperforming small caps, we also have this issue of growth outperforming value. And this is something we've been watching for a little while, and this goes back to 2024. So a little bit more data here, but you can definitely see where there's been bouts of kind of a little bit of ground being made up by value relative to growth, but that is like we saw in the last slide, has definitely gone the other way. So what's very poignant in the market now is that you've got growth outperforming value, and particularly large cap growth is outperforming just about everything right now. Another chart that kind of emphasizes the current dynamic in the market is this one. And so this is basically the basic necessity stocks. Let's just call them the food companies. And this is the food companies' performance relative to the overall S&P 500. And this goes back to 1986. So a lot of data here. You can see in the tech bubble when we were talking about pets.com as the new frontier, that people didn't want to own food stocks and they were trading at a massive discount to the rest of the S&P 500, which at that time, as we all remember, was bubbling up with technology. And same deal right now. We've got a huge performance differential relative to the broader S&P 500. And as we just saw, 40% of the index is in the top 10 companies. And those top 10 companies just happen to be technology and technology related. So history is repeating itself to some degree here. Now we'll talk about advanced decline, a little bit more of a technical type conversation here, but really the takeaways is that the broader S&P 500 index is just acting differently from mid and small caps. And we already talked about how small caps are underperforming large caps, and the S&P 500 does generally represent about 85% of the market cap of the overall market, and it's having a little bit better participation here over the last several months. Now, that's not to say that we don't have concentration risk, because we absolutely have concentration risk, but at least a little bit more of the rest of the market is participating in this market growth that we've seen. Now, that is not the case with mid caps or small caps, where we have had decreasing breadth across the market. Here we have the volatility index, which I have been talking about on occasion. We have data going back to the beginning of last year. You can see notable spikes. This would be the tariff tantrum. So we did have volatility move lower in the equity markets over the course of a few months here, but it's picked back up. Latest tick has been a little bit higher. So again, not out of line. When you get volatility that's kind of hovering at or below 20, I'm not gonna say it's unremarkable, but it's just less remarkable than if you had volatility that was consistently in the 20 to 30 range, which could happen, but is certainly not the case right now. Now we will talk about something that has a little bit of predictive power insofar as market turns are concerned. This is margin debt, and let's explain that for a second. It just represents people, investors that are buying on credit. So they're leveraging stock purchases, meaning that they're borrowing funds essentially to make additional stock purchases with that borrowed money. And when you see that a spike in margin debt, it typically corresponds with a market that's a little bit kind of late in its cycle, meaning that it's there's a lot of exuberance, a lot of confidence, not a lot of volatility. And if you look at this time series, it starts really in 2000. Here we have the tech bubble. You had a lot of people that were buying speculatively on margin, and then we had a downturn, right, where the tech bubble bursted and margin debt went down, because the last thing you want to own as an investor, or the last thing you want to be involved in as an investor in a rapidly declining market is a lot of margin debt. And you can see global financial crisis. We actually had a little bit of froth there too, and obviously went down. And this is all inherently cyclical as we look at the S&P 500 that has made a few gyrations. And then the pandemic. In the aftermath, we had a spike, and then that obviously corrected in 2022. But now we're back up to these levels again that, when you think about it historically, they're a little bit high. Now, the big rhetorical question here is this going to lead to something adverse? And the answer is I don't really know. Margin debt is a little bit higher. So that just means that people are a little bit less worried, a little bit more complacent, and but that sentiment can change relatively quickly. So we talk about, sentiment changing quickly. This is something that we watch in kind of a real-time basis. This is the American Association of Individual Investors Sentiment Indicator. And you can see that the net indicator is now turned back negative again. You can see the green line is the proportion of bullish respondents, and that number has gone down at the same time that the proportion of bearish uh, respondents has gone up. And so a little bit more concern in the market. So tying this back to margin debt, maybe this is something that the sentiment seems to be kind of mixed right now. And so again, all the more reason to be eyes wide open to what's going on here. We have a little bit of a busy chart here, but basically I'm going to talk about credit spreads, and I'm really just going to focus on the upper part of this chart here. And so this is in the fixed income realm. And so what credit spreads tell you, a credit spread is just basically the difference between the yield in a bond that has more risk to it relative to the U.S. Treasury, which is deemed to not have risk to it. And so that's called a credit spread. And so when credit spreads are really tight, there's a lot of confidence in economic growth. There's a lot of confidence that the companies that are issuing this debt are not going to go exhibit financial duress or go into bankruptcy or receivership or any of that. So we did have a period where those credit spreads were really low, and right now on this chart we're focusing on technology. We're focusing on, and the red line is big tech and Oracle, and the other colored line here is just basically tech, including some of the Mag 7 stocks. And CDS represents credit default swaps. And so these are essentially contracts that are providing, are basically measuring the inherent risk of these instruments that they're underwriting. Again, all of these companies here. And so that perceived risk has gone higher. And I did hear something in some of the read something in some of the research I had this weekend that said the most powerful trade in the market right now might be to short the bonds of the Mag 7. And that would certainly corroborate that, because we've seen credit spreads really blow out a little bit there. Kind of shift gears here on the bond market with this chart, because we talk a lot about the equity market future returns based on current price to earnings multiples and things like that. Well, you can do the same thing with bonds, and so this is what this chart is attempting to do. It's showing you in the black line here the 10-year yield going back to essentially 1970. And then you can see here we had kind of that hyperinflation leading into the early 1980s when President Reagan took over. Paul Volcker, announced his war on inflation, and so we had multiple decades of declining overall yields as that inflation was being taken off the plate. And so you can see that the blue line here represents the subsequent 10-year return at one of these marking points. And so there's a really tight correlation here. And so because of that 10-year gap, so we're just waiting on this data to fill in. But the idea is that while we've had some maybe some lousy, not lousy, but just less constructive bond returns over a period of several years, the outlook is a little bit brighter now that we have higher interest rates overall, and that following a period where we were really kind of depending mostly on price appreciation as interest rates were going down, and that means prices were going up, so on and so forth, that we were depending on that for most of our return. But now that we have real yields that are above where they were, then those expectations for future bond returns are looking a little bit brighter. So now we'll transition to some economic data I think is pretty helpful to take in total, because what I'm going to show you kind of paints a mixed picture here. And so in this chart we have the Bloomberg U.S. Financial Conditions Index, and you can see here that it has lately maybe gone down a little bit over maybe the last year, but it's still above its trend line. And you can see that maybe even more recently it's ticked up. And then, so that's in the green. And then in the blue line here, we have real GDP, which by this measure, it might appear that we have seen kind of a trough in the GDP numbers and maybe that they're going to go back up. Again, this is, you're just trying to use the past as a potential prologue. Sometimes it works out, sometimes it doesn't, but there is a pretty good relationship here, even if it doesn't, even if, basically one works at a lag to the other, that being GDP, reacts after the financial conditions kind of take hold. So, I mean, that could very well be the case that maybe we have seen kind of that trough point in the economy and that we're poised for reacceleration. We'll just have to wait and see. Another thing that we spend a lot of time thinking about, I mean, it's just kind of a soft indicator, is what CEOs are saying on the earnings calls. And so, in this chart from Bloomberg, you have the mentions of economic slowdown in these earnings calls and kind of the prevalence of that. You can see here that that number has really gone down almost to zero. So CEOs are much more confident than they have been in the past. Here we have another sentiment indicator from the National Federation of Independent Business. So this is basically the sentiment of small business. Now, we saw that in the prior chart, the CEO sentiment essentially coming from larger publicly traded firms. This is coming from small firms. And you can see, while we're not back at the highs here, that we're certainly off our troughs that we've seen over the last couple of years. So overall, small business sentiment is a little bit better and trending a little bit higher. Now we have the NFIB optimism index. You can see maybe off its highs, but still higher than it has been over the last several years. So, you kind of take that as a net positive. And then over here, you basically have small business profits and sales. And so this would tend to correlate. If small businesses are a little bit more optimistic, they're actually seeing better sales and profits. So continuing to talk about small businesses, here is their kind of their price expectations. Here's NFIB small businesses price plan. So this is basically at a 3-month lead time here. It's showing you the plans by small business to raise prices, and you can see that there's an upward bias here. And so that obviously they feel like they can get price. That's why they're indicating that they're going to be raising prices. And by judging by the trends in the two prior charts that I showed you about sentiment, that they feel like they're going to get that price and it's going to improve their profitability. And so here we are. So this is the kind of the self-fulfilling prophecy. If you can increase prices to at least cover your and sustain your margins, if not increase your profitability, obviously that's going to make those sentiment indicators pretty robust. Now this is inflation. Headline inflation, which we knew was going down for a while and has just recently turned back up because of some tariff issues on the margin, which we well understand right now. It's not any kind of a shock. So just wrap a bow around small business by saying, they're actually not feeling too bad. So capital spending and uncertainty kind of go hand in hand, kind of inverse relationship there. But here we have basically capital spending plans from the NFIB, and that's in the black line. So it has trended down. It has recently picked back up at the same time that we've got real business fixed investment. Now these are national numbers, and you can see that there's a reasonable relationship, less correlated during that particular decade. But that seems to be a little bit elevated as well. Now, what's really interesting here is that we've had a spike in uncertainty related to the tariff tantrum. And again, this data series goes back to about 1980. And you can see how uncertainty has trended over time. And you can probably correlate these with various economic and geopolitical issues. But uncertainty is still elevated relative to history. And at times we've kind of thought, okay, that's going to put a lid on capital spending. But right now it seems that companies like I mentioned, closing out the last slide, they're just they're feeling relatively good at the moment. This is a chart from the Institute for Supply Management. This is the basically both the manufacturing and the services component that's tied to business employment. So this is a sentiment indicator that's telling us both within the manufacturing realm as well as the service realm in the amber here what the expected trends in employment are, and they're both ticking up. So it's another positive development, which unfortunately will be offset a little bit by some of the data that we're seeing on the labor market, but at least in the ISM surveys, labor is looking a little bit better. Here we have retail sales. This is the carts tracking. This is a Chicago Fed indicator because we don't have some official statistics from the government. And it looks like the retail sales have picked up a little bit. You can see that can be lumpy from month to month, but so far near-term trend is certainly not unfavorable. Another chart from Apollo that I thought was pretty interesting, and it really kind of puts things into perspective. Now, we have talked about delinquencies in the consumer sector and how some of those have picked up, and some of those clearly have been. Student loans, auto loans, we'll see that a little bit later. But when we say the average collection amount per person is in this blue line, you can see the aggregate collection numbers are a little bit higher, and this is on this right-hand scale here. But the proportion of consumers that have collection that are in collection activity is actually very low. So we did know that over a period of time that people were working hard on basically the consumer America was working on its balance sheet and reducing debt levels, and that certainly played out. Maybe we're troughing here, but the proportion of consumers that are experiencing third-party collection activity is actually very, very low relative to where it was, not too long ago. And although the aggregate dollar amounts are a little bit higher. And some other indicators on the labor market. We've got the employment index for small business. So this is from Paycheck. So mind you, we're kind of filtering in some of these indicators that are coming from the private sector, knowing that government stats are not available, and unfortunately, what we're hearing is that some of this data might never be available, meaning that we'll have gaps in the government data. But here showing a little bit of a downtick in labor. This is not a surprise to me, nor should it be to you. Even though we've got the NFIB surveys that are maybe showing an uptick in labor, that's just kind of a sentiment number. But for a while, what the labor markets were exhibiting was, companies that weren't hiring, but they weren't necessarily laying off either. And so what we're seeing now is maybe a little bit more of a proactive stance on trimming staffs that are not productive. This is a chart with data from Gusto, which is a payroll provider. And you can see this is a seasonally adjusted net hires. And you can see this data is particularly lumpy, and I honestly don't have any idea what their sample size is. It's reported by Arbor. So again, when we're clamoring for these private data sources, we'll look at just about everything. But what this is telling us kind of corroborates with the prior slide, and that labor seems to be kind of like weakening just a little bit. Here we have a probability of a 25 basis point cut in the Fed meeting next month. And that has actually gone down. It's currently basically a coin flip right now as to whether there's going to be a rate cut. Fed Chairman Powell, after the last meeting, said that it wasn't a gimme, that it wasn't guaranteed that we're going to have it. And we just talked about the labor market. Sentiment indicators on labor seem to be better than the actual data. So I think net maybe labor is softening, which again, not surprising. You kind of would probably expect that. So that's one mandate. The other mandate is stable prices. And there we've seen a little bit of a slight uptick, which has kind of given some people pause that why, if you're, potentially witnessing, increased inflation from tariffs, why would you want to lower interest rates to help fuel the fire? Well, I think what the Fed is pivoting to now is the labor data, and that's the most important thing in its mind right now. Not forgetting about inflation, but just having that be more, placing more emphasis on that relative to, or more emphasis on the labor market relative to inflation in terms of their decision making. Here we have some of those delinquencies that I was talking about. So, well, I think maybe credit might be turning a corner here. We still have to acknowledge what's going on out there. We've got non-performing loans in the student loan asset-backed security market, that's ABS. And then auto loans on the books of banks. You've got non-performing loans, which have moved higher. But again, I might argue here is maybe cresting, so we'll have to wait and see. But really, and when you look at credit, even where areas are elevated, you look at auto loans and there's other types of credit, it does seem to be cresting and maybe reaching an interim peak here. So the only area that's not is in student loans, and that has a lot to do with the resumption of payments after that long moratorium on student debt. We have Americans behind on car payments has now hit a record. Obviously, it's not translating into delinquencies. Again, we want to see if this is kind of cresting here. You basically have around 6.5% of those borrowers are now exhibiting some stress. Again, this is not a new phenomenon. This has been trending higher for a number of years. I think some of that has to do with the higher net payments because, let's face it, we're not getting zero interest rate loans anymore. The interest rates are higher, and so that debt service component is just higher for folks that might not be witnessing the same level of income gains in their job. Bankruptcy filings, if we look at on a year-over-year basis, this would be year-to-date through October, certainly higher than the last couple of years, certainly higher than the post-pandemic environment. And so, while you have small business optimism, you also have some small businesses that are going away. Another chart related to inflation. So this is basically a chart that shows us that you've got the percent of items that have a monthly price growth rate of greater than 3%. So just think of it as the percent of the items within the CPI that are growing faster than the overall rate of inflation. And you can see that number is around 55% and has come up over the last couple of years. And so I would say, there's some kind of underlying themes on this chart, like depicted in these captions here. But like first inflation, obviously we knew the stimulus was providing a lot of inflation, and it was affecting most of the CPI, the Consumer Price Index. Here is the speculation is that going to be a problem? We're not yet at these 70 to 75% levels, but it is worth watching, because I think you could argue away, CPI maybe finding its way back down if it was only a very small subset of the components of CPI that were actually inflating at that excessive rate. But what we see here is it's basically a little bit more than half of those components are growing faster than the overall rate of inflation. This chart, we have just healthcare premiums. We go back to 1999, and the average employee contribution is about $1,500 a month. That is now $6,800, almost $6,900. But you can see here too that the employers are picking up a much bigger share of that. The total cost here is, call it $26,000 a year. Employers are still coughing up the lion's share of it, but you can see, put a growth rate on this, and it's pretty impressive over a period of about 25 years. Freight index, something else that we look at for signs of economic health or stress. We see that going down. So overland, or excuse me, oversea freight has gone down. You see rates are going down as a result of that. Some of that is tariff related, and these kind of like the manufactured kind of impediments to trade that we've seen a lot of this year. But that's clearly having an impact on container shipments and the overall freight index. Here we have median age of all U.S. home buyers is now almost 60 years of age. Last week we showed you the chart of the median age of first-time home buyers, and that was around 40. But again, this is a chart that goes back all the way to 1980, and you can see how affordability has really, I think, played a part. I think over time, obviously, you've got incomes rising, and sometimes they rise disproportionate to home prices, and it creates some stress for home buyers. But you can see that stress really embed itself over the last probably 4 years. So we've got a price of groceries too. This is something else, and this is part of what we were alluding to last week in what I was describing as the K-shaped economy. And that's where the haves or the upper income cohorts are actually pretty comfortable, and they're pretty confident, and their sentiment responses are pretty favorable. Well, the lower income cohorts are witnessing this right here, and not only during the rapid rise of inflation did they see a big pinch on the average price for a basket of groceries, but it's continued on. And you think about like 2021, or let's go back to the pandemic, and the average basket of groceries was like just under $800, and now it's over $1,000. And to that lower income cohort, that's real money. And this is why we have this K-shaped economy, because the people who spend a disproportionate amount of their income on things like groceries and gasoline are not feeling as good as the rest of the population. Now we have food prices here, which we were just talking about. Food prices are going up. Here we have more on the K-shaped economy here. We've got in this color, we've got the lowest wage quartile, and this is basically from the Atlanta Fed, the measure of nominal wage growth. And you can see it's come down for basically all income cohorts, but more pronounced for that lowest wage. And whereas some of the higher wage quartiles, even though they're witnessing declines in wage growth, not nearly as pronounced as the lowest wage quartile. This is from B of A. This is basically the proportion of people by income levels that are living paycheck to paycheck over a period of 3 separate years. You've got 2023 through 25. You can see lower income folks. You've got basically now almost 30% that are living paycheck to paycheck. And you can see how that's gone up every year. And middle income, you can see, obviously you'd expect it to be a lower number that are living paycheck to paycheck, but even that too has gone a little bit higher. And the highest income, just because they tend to have, more robust spending habits, and, we know that the highest income tiers account for about half of all consumption. Even here, we've seen a little bit of an increase over a 3-year period, although it's flatlined over the last year. And on this slide, which will end, just kind of highlighting the fact that China is pivoting with all the trade barriers that we have now. And it's not speaking to the issues of rare earths, which is still very much in contention. So, I wouldn't sleep on trade because there's still a lot of risk out there for trade, and you can see here that China is in fact pivoting away from us over a period of many months. That the exports to the U.S. are going down because of these tariffs, but China's not. They're sleeping pretty well at night because they're exporting a lot of these to the rest of Asia. That's all we have for the chart pack this week. Hope you've enjoyed it. Have a great week, and we'll talk to you again soon.